In a move that sent shockwaves through global markets, former President Donald Trump announced sweeping new tariffs on goods imported from Canada, Mexico, and China. These tariffs, ranging from 10 to 25%, have reignited fears of a trade war and injected a fresh wave of uncertainty into the global economic outlook. The move, seen by many as a step backward in international trade relations, has left businesses and investors grappling with the potential consequences. The tariffs, a cornerstone of Trump's economic policy during his presidency, are designed to protect American industries and jobs. However, critics argue that they could backfire, leading to higher prices for consumers and retaliatory measures from trading partners. The situation is further complicated by the fact that the global economy is still recovering from the COVID-19 pandemic, making it more vulnerable to shocks. The impact of these tariffs is already being felt across a range of industries, from agriculture to manufacturing. Businesses are facing higher costs for imported materials, and consumers are seeing prices rise on everyday goods. The situation is particularly acute in industries heavily reliant on global supply chains, which are now facing disruptions and delays. The return of tariffs has reignited the debate over the benefits of free trade versus protectionism. While Trump has argued that tariffs are necessary to protect American interests, others warn that they could ultimately harm the U.S. economy by reducing competition and innovation. As the situation continues to unfold, businesses and investors alike are closely monitoring developments and bracing for the potential impact. The cryptocurrency market, known for its volatility, has reacted sharply to the announcement of new tariffs. Bitcoin, the world's largest cryptocurrency by market capitalization, experienced a significant drop in value following Trump's announcement. This decline highlights the growing interconnectedness between the crypto market and traditional financial markets. The drop in Bitcoin's price can be attributed to several factors. Firstly, the tariffs have created uncertainty in the global market, prompting investors to move away from riskier assets like cryptocurrencies and towards safer havens like gold. Secondly, the tariffs are expected to contribute to inflation, which could erode the purchasing power of cryptocurrencies. This sensitivity to macroeconomic factors underscores the evolving nature of the cryptocurrency market. While once considered a fringe asset class, cryptocurrencies are increasingly viewed as part of the broader financial landscape. This means they are now more susceptible to the same forces that drive traditional markets, including geopolitical events, economic policies, and investor sentiment. The impact of the tariffs on Bitcoin is a stark reminder that the cryptocurrency market is not immune to global events. As the situation unfolds, investors are watching closely to see how the market will react and whether this will lead to a prolonged bear market or a buying opportunity. The reintroduction of tariffs has injected a significant dose of volatility into the markets, leaving investors grappling with uncertainty and fear. The uncertainty stems from the unpredictable nature of trade wars and the potential for escalation. Investors are unsure how other countries will respond to Trump's tariffs or how long these trade disputes will last. This fear is palpable in the stock market, where major indices have experienced significant swings following Trump's announcement. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite have all seen their gains for the year wiped out, reflecting the heightened anxiety among investors. Adding to the unease is the specter of inflation. The tariffs, by increasing the cost of imported goods, are expected to push prices higher for consumers. This could force the Federal Reserve to raise interest rates more aggressively than anticipated, potentially slowing down economic growth. This combination of volatility, fear, and inflationary pressures has created a challenging environment for investors. Many are choosing to sit on the sidelines, waiting for more clarity on the trade situation before making any significant investment decisions. This wait-and-see approach is likely to persist until there are clear signs of a resolution to the trade disputes. Donald Trump's re-emergence on the political stage, coupled with his self-proclaimed status as a crypto candidate, has added another layer of complexity to the already volatile cryptocurrency market. Trump's past pronouncements on cryptocurrencies have been mixed, ranging from skepticism to outright hostility. His return to the political arena, with its potential for policy shifts and market disruptions, has made investors particularly sensitive to his every word and action related to cryptocurrencies. Any indication of a change in his stance, whether positive or negative, could send ripples through the market. This heightened sensitivity is further amplified by Trump's unpredictable nature and his penchant for making policy decisions via Twitter. His pronouncements, often made without prior warning or consultation, have the potential to move markets dramatically, leaving investors scrambling to react. The crypto market, still in its nascent stage of development and lacking established regulatory frameworks, is particularly vulnerable to such external shocks. The lack of clarity and predictability in Trump's approach to crypto regulation adds to the uncertainty, making it difficult for investors to gauge the long-term viability and profitability of cryptocurrencies. The recent volatility in the cryptocurrency market highlights a significant trend: the growing correlation between cryptocurrencies and traditional financial markets, particularly the stock market. This interconnectedness is a double-edged sword, offering both opportunities and risks for crypto investors. On the one hand, the increasing correlation with the stock market provides a degree of legitimacy and familiarity to cryptocurrencies. As institutional investors and mainstream players enter the market, they bring with them their investment strategies and risk appetite, which often mirror those of the traditional financial markets. On the other hand, this growing correlation also exposes cryptocurrencies to the same systemic risks and volatilities that plague traditional markets. Events like the reintroduction of tariffs, which send shockwaves through the stock market, are now also impacting cryptocurrencies, demonstrating that crypto is no longer an isolated niche asset class. This mirroring effect underscores the need for crypto investors to adopt a more sophisticated approach to risk management. Relying solely on the perceived independence of cryptocurrencies from traditional markets is no longer a viable strategy. Investors need to be cognizant of the broader economic and geopolitical landscape and adjust their portfolios accordingly.